Hi everyone, my name is Piterpakulski. Today we'll continue building financial model for a Uber, Lyft, taxi financial model, business idea. And today we will be purchasing a car, and today we will be adding a loan to this project. So if this video will be valuable for you, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials. And when I will finish this model, I will give you all the links in the description of this video, so you may watch tutorial by tutorial from scratch how I created this model. So first of all, let's quickly run through the model that we already created during previous tutorials. So blue cells are our inputs. So we have the library of different types of trips. Here we specify the mileage, duration, revenue. We can switch them on and off from calculations. Then we started specifying the amount of trips for a specific day of the week. Inside the typical week we can add different coefficients, switch on and off different types of trips from this or that day of the typical week. We can switch on and off different days of the week from our calculations to see the cash flow statement with or without this or that day of the week. Then we were specifying when we are going to start operating activity. Then we moved to the block of inputs where we were specifying how fast we are going to reach our target revenues from the moment when we start operating activity. Then we moved to expenses. So we specified when we are going to sell an old car. So then we started talking about periodic dealership maintenance. So this is the mileage, this is the cost of service at the dealership, these are costs of parts, and these are the months of operating activity of the car. And now we need to first of all we need to buy the car. So let's create a new block of inputs. So this will be let's put it here. For example, let's add some lines here. So the car price in dollars. So for example, our car will cost us, let's say, $35,000. And here we have the cycles of operating activity of the car. That when we won here, this is the moment when we buy a new car.
So let's add a line here. And let's create a new line and name it purchasing a new car.
So one means that this is the moment when we are buying this car. So if this value equals to 1, we will put 1, otherwise 0. So we are displacing a purchase of a car 1 month prior it starts the operating activity. So here is this moment. here is this moment. So this is the moment when we are buying the car. Then let's place the actual values. Purchasing a new car, this will be $1. So we will just place equals and multiply it on the car price. Let's freeze this cell. Now let's extrapolate this formula to the right. So this is the moment when we are buying a new car. Let's highlight it with red because this line will go later to the cash flow statement as an investment stage expenses. And now let's assume that, for example, we would like to take a loan to buy this car. So for example, the down payment percentage, so let's say that we are giving 10% down payment to get this car, and this down payment in dollars will be $3,500. Then we are specifying the interest rate. Let's say it is 7%, for example. Then let's specify term of loan. So the term of loan, let's say it will be 36 months. And here let's put maximum operating activity period. So I will put, according to our model, for example, so the maximum period of operating activity will be 26 months, and then the car becomes old and we are gonna sell it. So this means that our loan should be let's say 22 months, to be inside this period. So this means that we are we already sold the car, but we are still paying for the loan. So to avoid this, let's put this maximum operating activity period close to the loan term. Now let's calculate principal payment. $1 per month. And this will be the price of the car minus down payment and divided by the term of the loan. So the monthly principal payment will be $1,400. Then let's calculate the interest payments. So this will be, let's create a new table. So let's say that the maximum period of the loan will be 10 years. Loan timeline. So principal payment will be if this value is less or equals the term of the loan, then we will place here the principal payment. Otherwise 0. So this is the first component. The next component, we need to calculate the interest paid, but for that we need to know the principal which is left to pay at any given moment. So principal, let's say at any given moment. So first of all, here the principal will be the price of the car minus down payment, and then here will be this value minus this, so now we know the principal at any given moment. Then we can calculate the interest paid. Let's say step 1. So what we will do, we will multiply this value, the principal, we will multiply on the interest rate, and then we will divide it by 12 to get the monthly value. Now let's create a total for the interest payments, And now let's calculate the average interest paid dollar per month. And principal payments. So if this value is more than 0, means that if we paying the principal, then we will pay the interest. So we will pay this value, total interest paid during the period of loan, divided by the term of the loan. Otherwise 0. So if we extrapolate this formula to the right, so we will be able to see that the totals are the same, but here we have the regression, and here are the payments are stable. So the loan payment, so the loan payment dollar per month will be principal payments plus interest So let's adjust this cell because this is not the input, this is a formula. So here let's first of all create the line for down payment. So I will take this cell and multiply it on the amount of down payment. So here we have two scenarios. One scenario is for purchasing the car for 100% money from the pocket, and this scenario will be when we are purchasing the car using the loan. And now, so here's the down payment, and now we need to calculate the interest and principal payment for the loan. So for that purpose we will create an additional line. Let's put it here. Loan payments start. So if this value equals to 1, then we put 1, otherwise 0.
I will mark this line with this color, and now I will create a new table loan 0 1 0. So this will be the first table that I need. Here I will be counting months of operating activity of the horizon of our project. So these are months of horizon of our project, and now let's put the moment when each cycle starts inside this table. So if this value freezing the line equals to this value, freezing the column, then we will put this value, freezing the line, otherwise 0. So here in this table we will be able to see this when each cycle of each car starts. Then the next exercise, we need to count the months of the loan. So if this value is more than 0, we will put 1, otherwise 0. And here we will write a bit another formula. So if and this value equals to 0 and this value equals to 0, we will put 0. Then the second scenario, if this one equals to 0, this is more than 0, we will put 1. Then if this value if and this value is more than 0 and this value is less than the period of loan, is less than the period of loan, we are freezing the cell, then we are adding +1, otherwise 0, and closing all the brackets now. Now let's extrapolate this formula to the bottom and to the right. So here we can see in this table the cycles of the loan.
So this is the first cycle starting here.
So here we can see the end of one cycle of the loan, and if we go a little bit to the bottom, we will be able to see a new cycle of the loan starting here. A new cycle. So now we've managed to automate our cycles, loan cycles,
And let's group this, by the way.
and now let's calculate the loan payments. So I will hide this as well. It's too early. So first of all, so here we get the principal payment.
Then let's add a line here. So the loan payment will be $1 per month.
This will be principal payment plus interest paid. And now we will be writing a very simple. So loan payment will be if this value is more than 0, this means that we do have a cycle, loan cycle at this moment. Then we will place a loan payment. And then otherwise 0. Now we'll extrapolate this formula to the bottom and to the right. So now we can see here the loan payments according to the cycles. Now let's summarize this data. Let's create here a new line. So this will be a loan. So this will be a loan payment, $1 per month, and this will be a total of the table that we've just created. So now what we can see that this is down payment, these are loan payments, new car, loan payments. So we automate the cycles. For example, if we want to decrease the loan term just to 12 months, we can do it here. So now we've managed to automate this story, and we can even further create switching scenarios between purchasing a new car from the pocket or using a loan. So we will be doing it during the next videos. I hope you enjoyed this video. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will keep all these tutorials, and when I finish this financial model, I will give you all the links in the description of this video as well, so you may watch them one by one from scratch. So thank you guys for watching, see you next videos, thank you and bye.